Today we're going to be talking about why market makers are vital in a bull run, although they're definitely vital all the time. I'll move down one chair then. So just to go ahead and get started, we have Patrick here from IMC, we have Jonathan from G20, and we have Mr. Francesco from Keyrock. And I'm going to go ahead and let each of them start by introducing themselves quickly. Please, Patrick.
Sure. Hi, everyone. My name is Patrick. I work at IMC Trading. IMC Trading is a top 10 market maker across all asset classes, basically. We trade options, equities, bonds, but also crypto. So I'm focusing on the crypto side of things. We have an office here in Zug. Around 50 people working full-time on crypto. And yeah, very excited to be here. Thanks so much.
Thank you.
Hi, everyone. I'm Jonathan Mathai. I'm one of the co-founders and head of trading at G20. We're also a cross-asset trading firm, started with our roots in quantitative FX trading, but branched out into crypto and other asset classes afterwards. So pleasure to be here.
Hi, everyone. My name is Francesco. I'm obviously an investment banker by trade and not a crypto native. Spent most of my career at Goldman Sachs. And since the end of last year, I'm a board member at Keyrock, and now recently are helping on the operational side as a COO at the company.
Wonderful. So thank you for introducing yourselves. I'd like to start off with a little bit of a contrast between what we spoke about last year on this panel, and that was how market making looked in a bear market or a market that was emerging from a bear market. And now I would say we all agree, or most of us agree, we're in a bull market. So how is market making different in this market compared to what it was in 2022, 2023? Maybe we'll start with you, Patrick.
Sure. Yeah, I think we're definitely back in a bull market, or at least on the way towards that. I think like this question has a lot of angles that you can tackle it from. So let me just like point out like two things that I think are important. One thing is transparency. Transparency has changed a lot. We see it a lot like back in the days, last bull market, or also in the bear market, there was not really like the access for the projects that you do market making for. To get like all the information, all the data, having KPIs in place. And I think now these days, the projects, they are much more sophisticated. They either have someone internal that supports them towards market making stuff and trading, or they have an advisor that supports them. So it's much more, the KPIs are clear right now. They also get integrated and written down in a contract, which makes the market maker also like binding to basically fulfill them, which we think is great because we come from the TradFi space. We really believe in transparency. And yeah, there are also no misunderstandings towards the project. And I think the second point I want to make before I hand over to you guys is I think it's much more a long-term partnership these days. So if you enter an agreement with a project, it's not just about market making as a service. It's really about being a long-term partner, supporting them from when they start, when they fundraise. Maybe you put in a ticket as well, support them there financially, and then you grow together with them. You advise them until TG happens and also beyond. And then obviously like market making is also one piece of that. You support the treasury with OTC transactions, like all sorts of things that basically touch trading in a way.
Excellent. Thank you.
Yeah, I think thanks. I think one of the things is that everyone gets much less sleep in a bull market. It's a lot busier. There's a rush to market from a lot of projects because in the bear market people are thinking about building and product. In the bull market, it's go to market for listing and things like this. That's one of the points. In general, for the sort of more established projects, there's a lot more volume and there's a lot more volatility as well. So that the market is very busy the whole time. There's always a move, and I think there are some markets where everything moves together, And then there are other times when it's more thematic based as well. So yeah, it's an interesting time, much more interesting in the bull markets than the bears.
Yeah, look, market makers, they provide inventory, right? So in a market where volumes are much higher, volatility is higher, dispersion is higher, and there's a higher amount of capital at disposal, it's easier, marginally easier to hold inventory and do the job they're supposed to be doing, number one. Number two, obviously markets go in cycles, and compared to the last bull cycle that we had, also, the markets which are above, one derivative above than spot, have also improved. And so it's much easier, or at least easier than it was last time, to operate as a market maker because of the reasons that I just mentioned. And on top of that, if you have additional instruments which trade, with a higher liquidity, including futures and options and so on and so forth, across all other exchanges, it makes your job easier, right? And yeah, I think that's the way I would answer the question.
Excellent. Thank you for that. So it sounds like all of your firms are having a lot more business, influx of business. Now, in terms of those businesses, are some of you focused more on smaller micro-cap tokens and coins versus the larger coins? Are some of you focused on providing market making for exchanges, like you have in a relationship with the exchange? Like, who are each of your customer bases? Like, who are your clients? Maybe we could start with you, Patrick.
Sure.
Sorry.
No, please go ahead. I will
meant
go
with
last this
Jonathan,
time.
sorry.
Sure. Yeah, so we do a mixture of different mandates. We trade for ourselves as a proprietary trading firm, but we also have client mandates across the board. Some with very liquid tokens in the top 50 and so on, and others with newly listed projects as well, which are going to market for the first time. So we cover the full spectrum. We also work with some exchanges too to improve their liquidity. So we help across the board where we can.
Yeah. Well, to Keyrock has not only the classical agency business on the market making side that is split in two, on the one side high liquidity and low liquidity, but also, for example, HFT, high frequency trading. And I'm not going to be able to say a lot about that just because it's HFT and it's a secret sauce that everybody wants to keep for itself. And the last one is derivatives. And I'll say the reason why I say and I talk about derivatives is that having an activity on the derivative side facilitates us in terms of taking on more and more business on the low liquidity side of the spectrum. So obviously we make markets on Bitcoin and ETH and the very large cap coins, but the space is crowded, right? So what we do is obviously take on less liquid tokens. Why do we do that? Well, because we have another leg in the business, which is the derivative leg, which helps us financing and supporting the second one that I just mentioned. So the split, I'm not going to throw any numbers, but we're evenly spread across HL, LL, HFT, and derivatives.
Yes, I think for us at IMC, the setup is very similar. The company is around for 35 years now, and they were constantly developing their algos, the proprietary algos. And yeah, we are very strong in high frequency trading across the board. And it's basically how we also entered crypto back in the days. And we saw that, yeah, we could really compete aggressively with all the other participants. And then we also decided to get into more this client-facing business, like you guys are as well. We started that roughly like 1.5 years ago and are constantly growing this franchise as well. But for now, it's still like, I would say, for us, coming back to your question, like smaller projects, we can do it, but I think we prefer like high liquid markets just because our algos are tweaked that way to function very well in high liquidity environments.
Interesting. So it kind of sounds like Keyrock and G20 are able to kind of look at some of those smaller token opportunities, and then it sounds like IMC is looking at the more highly liquid opportunities. So for example, sometimes I'll meet somebody that has a new project, they're launching in a new coin or a new token, and I'll ask them a question like, who is your market maker? And usually that's when they say, oh no, we want the exchange to want to list us, and we don't want to have to pay a fee, or we don't want to have to get a market maker. We want them to come to us and tell us that they're going to list us. And at that point, I usually say, well, you know, that's going to be pretty difficult because that's what every token ideally wants, right? That the exchange comes out to you and says, we want to list you. So for these smaller token projects, do they always have to have a market maker now if they're going to be listed? Is that like a mandatory requirement? Maybe we can start with you again, Jonathan.
Yeah, sure. Yeah, it's usually these days the centralized exchange looks for a number of criteria, and one of those is that they have an established market maker working with the project. I think you know, it's important as you list to have liquidity, and for the exchange's customers, that the retail customers in particular, that they have good execution and good fills for the trades that they do. So I think these days it's quite common to have a market maker. In fact, almost a requirement. Sometimes projects on that point, they you know, they're so focused on their product that the understanding of liquidity, you know, may not be there, and they think that maybe they can launch on a DEX, for example, as a starting point, which isn't really recommended as a go-to-market strategy.
Interesting. Yeah. How much of your activity is on DEXs right now versus on SEXs?
Well, the great majority for us is still SEXs, centralized exchanges, but we're expanding obviously and making, you know, try to be more active on the LP side on DEXs. And maybe to come back to the question you asked before, coming from TradeFi, it's difficult for me to have one token or one stock, for that matter, starting to be admitted to trading on an exchange. It can be Nasdaq or Deutsche Börse, it doesn't really matter, without a market making and thinking or expecting that the price discovery mechanism will be functioning, because it doesn't, at least at the beginning. So, you know, at the very beginning, I would have said, you know, having a market maker that makes markets and takes care of the token or the security on the other side is paramount. Obviously, if you look, for example, the percentage of volume generated and taken care of by a market maker on day one versus what's going to happen in 12 months' time, obviously, if at the beginning there may be 90, 95% of the volume, but if you progress and the market becomes more and more diverse, and what I mean by that, you have additional segments of clientele on both sides of the market. So not only retail, but also institutional clients. Not only retail institutional clients, but also hedge funds and so on and so forth. So the more diverse the bid and the offer side are, the less important is the role of the market maker. But that happens only along the way. Yeah.
Interesting, wonderful. So, I mean, I thought the goal of most market makers was to be market neutral. But last night I was talking to Mark from IMC, who was on the panel last year, and he said that that's not always the case. That sometimes they are directional and they are interested in the long-term, like, appreciation of the underlying assets that they market make for. So, how do you decide which projects you're directional on versus which projects you try to hedge? And yeah.
So, I mean, yeah, it's a good point. I mean, when you break it down to pure liquidity providing and market making, we always try to be delta neutral. So it means like if someone buys and we sell a token, then we obviously reverse the trade somewhere else, or we use derivatives to be flat and have no exposure, directional. In that sense, yes, in that case, we are definitely delta neutral, but we also have a prop side, right? So a prop side is basically, yeah, we trade with our funds, but also there, most of the time, we are delta neutral. Obviously, it can be from time to time that you're long a position or short a position. I mean, especially in low liquid markets, if it takes a little bit longer to hedge your position, or if there is no like instrument available to immediately hedge yourself, then you face the risk to be long, right? Because normally the hedging happens within milliseconds, because you obviously want to hedge before the price moves, basically. You want to lock in the hedge. So yeah, it can happen from time to time that you are, but we obviously, our goal is to be as delta neutral as possible for most of the time.
Yeah, I think to add to that as well, so we have maybe more of a client business where we have mandates with clients. Sometimes showing an order book means that in a bullish market, we know that we're going to see buying flow at some point. So to hedge against those moves, we have to maintain a slight long bias and across our books to deal with those flows. I mean, sometimes you can see in crypto in the bull market, 20% moves quite easily in a day, right? And so that's not unusual. And if you're mandated to show a 2% wide book, it's quite easy to get run over in that sense. So maintaining long positions is quite important in the bull market.
I think, my answer would be, it depends a lot on the origin or on how the company started. You have companies that started as a proprietary trading firm, and they live that through their whole existence, and then they expand into the franchise business, i.e., we're doing such a good job as a proprietary shop, and then we can offer that service in terms of execution on an agency basis also to our clients, or vice versa. There are companies that start by offering the service of making markets, and they're delta neutral, market neutral, and so on and so forth, and they develop the talent as well there for markets, and then they expand into the prop shop. I think as long as you have your conflict of interest under control at the firm level, it's good to have both, right? Maybe I'll mention Goldman. Goldman started as a franchise business, right? Issuing equity and debt. But then as markets developed and the firm realized that they had a strong grasp on risk, they could control risk, they realized they could run more risk than anybody else in the market. And that's why they all of a sudden, they skewed towards more the prop trading angle of the business. So it really depends on how you start.
Well, you kind of mentioned that there could be a conflict of interest at times, though, between these, because if you have a prop desk that has a position that's long or something like that, and then you tell your colleague that's working at the desk next door that's making the markets, how do you stop or how do you prevent these types of situations from occurring and when you have both in a company?
Yeah. Well, that probably has in TradeFi as well, right? That's why we have Chinese walls, obviously, right? ECM and DCM sit on one side of the business, the security and capital markets division on the other side, just because you want to avoid having the two sides talking to each other and mingling, right? How do you do it? Well, you build the wall, right? You build the wall inside the company and make sure that, if anybody needs to cross that wall, that everybody knows, including legal and compliance and so on and so forth. Now, that's TradeFi. And the regulation imposes on TradeFi certain rules. In crypto, well, where's the border? Where's the wall? There's no wall. So it's a matter of, the companies maturing and being mature enough to know that they need to manage the conflict of interest that they have, implicitly, obviously. Because otherwise you mix flows and you're, either doing a good job for the firm nor doing a good job for the firm.
Definitely.
Yeah. Yeah, I think we see it as well at IMC. I mean, we are 1,500 people, quite a big shop with 9 offices around the world, and we have licenses to trade on, like the CME or the New York Stock Exchange, etc. And for us, obviously, the compliance oversight is massive, right? Because if we do something wrong in the crypto side, then obviously the rest of the business is affected too, and we obviously don't want to risk our reputation there. So, as Francesco said, it's really, really important to differentiate between the two businesses and have like these internal risk mechanisms to kind of avoid this.
Interesting.
I think from a client side business as well, it's really important to maintain good relationships with your clients and for them to trust you completely in the market. For a lot of these firms, they are coming to a market maker because they need support on that side. They don't have their internal teams dealing with markets, right? So it's very much in our interest, and I'm sure for all of us, we would be looking after our clients, so to avoid conflicts of interest like that.
That makes sense. So right now I'm going to open it up to the audience for just a minute. Is there anyone here that's currently looking for a market maker? So you have a token project, you're looking for a market maker. Do you have a question for any of these gentlemen in terms of looking, or anyone in general have any questions for market making? Maybe
Ask the tough questions. Now
Yeah,
you
the
have
really
the
hard
opportunity.
Okay, well, yes.
Can you share your fees?
Share the fees. Excellent. Yeah. So maybe I don't know if you can, but if a coin came to you with a mandate and they wanted you to work with them, what would that involve? How would they pay you? Or, so they give you a loan of coins, and then over time, you have like an option on the price of those coins, or I don't know how
I
it
think,
all
I
works.
think there are different. I can make a start on it. Maybe please add as well. There are different types of fee models for clients. There's the straight-up retainer type style, where there's a fixed fee every month and a loan of tokens inventory to be able to manage. There's the loan and option style model as well, where there's no fee as such, but there's an option or a strip of options on the underlying, the token as well. And then there are volatility. There are sort of volume-based rebates. So the more volume you do, the more you're incentivized. So I think each client, I think one thing that's quite important in crypto is that there are so many projects, and each project has a niche or a particular requirement. So we don't tend to enforce a model on anyone. We'd say this. There's a number of frameworks. You can choose something that suits you, and we know that the sort of sometimes clients need a bit of time to get familiar or to become comfortable with each approach, and so we're very flexible generally with how those things kind of work.
Yeah, for us it's very similar. So we have all the different models. I think it really comes down to the project, and we try to accommodate as much as we can. And then it's, as I said, it's normally these days it's not just like one service that you provide. It's normally like multiple services, and you kind of try to accommodate as much as you can. And like normally there are not like implicit fees that you have to pay. I mean, like on an exchange, it's clear you pay such amount for maker, such amount for taker. With us, it's like, yeah, if you have the retainer model, then of course, then there's like a fixed fee. You pay that, and you're good to go. On the other side, normally how you incentivize a market maker is to give him some sort of upside on certain things, that if the project does well, the market maker kind of gets rewarded at the same time, right? So that I think it's important that all these incentives are kind of aligned, and that's therefore I think these kind of models are the best to foster a strong partnership.
Yeah, well, my answer is, the one that a lawyer would give. It depends, and it depends, from project to project, exactly, what the characteristics of the project are. But as he said, right, the most important thing is actually that whatever model it's used, that the incentives of the market maker and the token provider are aligned. That's the most important thing. Project would even want to pay more than what competitors show, as long as the counterparty they're doing the business with, has the same interest as the token itself. Because there's nothing worse than, getting a market maker making markets for your own token as cheaply as possible, and then realizing once this thing hits the market that they're working against you as opposed to, in favor of you.
Yeah, we've definitely seen a lot of coins that start trading on the secondary markets for the first time, and it's a rude awakening for all the investors. But yeah, definitely very interesting. So in terms of like being in the market, also again, last night I was talking to Mark at the VIP dinner, and Mark said that it's sometimes difficult for him to show the clients the success of IMC's own market making, because it's hard to decompose the order book and see how much the liquidity increased because of your actions versus another market maker's actions versus a difference in demand from the investors' side. So is there a way you can actually show your clients how you have improved liquidity?
Yeah, I mean, like you can have a look at the data, and you normally see like how much of the market you were basically trading, and this gives like kind of a good impression on how you were doing. Also, you look at spreads, you look at the different depths within the order book, like how much you were there, uptime, obviously, and I think like these are exactly the KPIs that the token teams these days want to see, right? And you report that back, and there are also like some third-party tools where they can basically monitor that and see like how the market making really is doing. And yeah, I think these are the metrics that they can see. obviously, like, yeah, the rest, like all the prop trading, you obviously don't give the information out there because it's, yeah, it's your sauce, and you don't want to, you know, like, give this information out. So, but yeah, on all these service deals, like, I mean, there are KPIs these days, you fulfill them, and that's basically how you can see how it developed, I would say.
I think regularly looking at the progress of those KPIs as well, of how much the volume percentage is of the total volume. I think we generally have a rule of thumb of somewhere between 15 to 30% of the volume is a good target to aim for. I think from a market making point of view, you don't want to be too little because then you're not done your job. But you don't want to be too much either because then there's not really a very organic market. So I think volume capture is an important one. And then I think venues as well, because for some bigger projects, they might be listed on 12, 13, 14 different venues. And so seeing the sort of capture across those different places and trying to make sure there's good liquidity on all of those, I think that's important.
I'm kind of surprised, that issuers, don't appreciate the value of market makers. Maybe what market makers should do is just disappear for a day and see what happens to the market, the central limit order book depth, see what happens with that, right? And then, kidding aside, there are metrics you can look at, obviously, and see, for example, if you have a certain amount of volume on any given day, how much of that volume has been matched between retail, and how much has been matched between retail and market maker, or market maker and retail. And then you see the difference. But otherwise, I know some of you might remember NASDAQ when they were still trading on the floor and they had these, cubicles back in the days, which were the specialists, right? The market makers. Just have the guy disappear for a day and see what happens to the market. It's not going to look good.
So it sounds like you're saying like 15 to 30% of an order book at any given time for a token that you're working with would be done by a market maker.
15 to 30% of the volume.
15 to 30% of the volume.
I'd say the order book is primarily market makers.
Okay.
Generally speaking, retail would be a taker on that order book, and it'll be the market maker or market makers, which are the make up the order book.
Exactly. Yeah. Okay. Good. Thank you for explaining that. So yesterday I was talking to somebody from Bybit, and he said that he thought the order book mostly was 90% market makers and 10%, other investors that just have their limit orders sitting in their account waiting to get filled. He said on the actual side of what trades actually get filled and the executed trades, he said he thought it was about 50-50. So 50% market makers, 50% traders that are from the market. So is that probably what you guys see? Is that different for, like, let's say, a smaller coin, or not? Okay, I don't want to say a smaller coin, but like a smaller coin versus a large coin. Like, is that composition different, or is it pretty much 50% of every order that's been executed? That's market making, or?
Well, my take, I don't know the numbers, but my take is large cap coins, the market makers' market share is probably relatively limited, if not zero. If you look at Bitcoin and ETH, no necessity in having a market maker on Bitcoin. Why? Well, because the market structure on that very token has been, developing over the last 13, 14 years. And the same applies for those, other large cap tokens. But, for low liquidity, small caps, with no market maker, there's no market. Well, there's only somebody offering and nobody buying. So I don't know if you can define that as a market.
Yeah, I'd agree with that. I think the smaller tokens, you definitely need a market maker, especially across like a number of different venues. I'd say that for maybe the names like IMC, you'd also be very active in Bitcoin and Ether there, right?
Yeah, exactly. So like the high liquidity tokens, I mean, like, there you go in with prop trading, and you obviously also don't want to be like too big of a market share, because if you trade high frequency, you always want to have the good trades. You want to be the first to arrive at the new levels, right? So you don't want to be second, you don't want to be third, because that would mean you potentially get a bad trade. So if you are 50% of an order book, then for sure you're going to have bad trades in there that are not really profitable. But yeah, also like coming back on the flow retail versus market makers, I think you get, as a market maker, when you're in the market, you get a lot of data from that, and you see very fast that if the order book is healthy or not, if you have toxic flow from like other market makers, or if you really trade against retail, right? And obviously, every market maker wants a healthy order book with a lot of retail flow to trade against, and not to trade against other market makers.
Is there any like sign that when you realize that you're trading against other market makers and that there's a lot of toxic flow, and then you're like, we need to get out of here, or?
Well, you see it in the P&L ultimately,
Okay.
right?
P&L, okay.
You obviously have risk mechanism in place to detect that early on, so you don't really run into a negative scenario. But yeah, you see it pretty fast.
I think we also with if it's another market maker, you typically expect them to be trading like top of the book, as in smaller size top of the book for limited slippage. Whereas if you with aggressive retail flows, like we've seen on certain exchanges recently, you'd expect them to sweep through the books more regularly.
Interesting.
Which is actually maybe an interesting point about exchanges. Actually, some of the exchanges recently have in this bull market have really the exchange mix has really changed. I think from the last bull market. I think we were talking about it earlier a bit about how exchanges like Bitvarvo, for example, have come up this time, which are very heavily retail focused. And then there are other exchanges like Gate, which have come up in the last 6 months or so, and behaving very differently to before as well.
Interesting. So, so Francisco, you joked a little bit earlier about, let's just see what happens if the market makers don't show up to work one day. Is there ever a time when market maker you pull out of the market? Like, for example, if hedging becomes prohibitively expensive, or you can't find a way to hedge, do you ever you just leave the market on your own accord?
Well, it depends on the agreement you have with the issuer, right? If you have a certain commitment, or you have delivered a certain commitment, say, I don't know, 95% uptime, a certain spread, a certain size inside that spread, and then you widen that out. If it's a commitment, it's a commitment, right? You get paid for that. So you should be making markets the way the issuer expects you to make in markets, because you get rewarded for that, right? Now, it makes a difference, if you get rewarded by getting a check at the end of the month, or if you get rewarded, and we mentioned that before, by being long call options on that very token, and so on and so forth. So it depends a lot on the structure. But, well, look, not every trade that a market maker enters is going to be a good trade. Sometimes you lose, sometimes you make money. But I guess the more the market structure develops and improves, the more instruments are at disposal of the market maker to hedge those risks. And what I mean by that is, across more exchanges with more volume, using derivatives, symmetric and non-symmetric derivatives, the less the chances you're going to be losing money on certain trades. But look, if you were making money at all times, we wouldn't be sitting here. I mean, at least I wouldn't be sitting here.
I think sometimes with let's say there's an exchange risk, for example, there's some news on Twitter that an exchange is going bankrupt. I think in those cases, even you'd probably pull out of the market and just wait and see, or withdraw assets and wait and see, especially if it's a client mandate, which where it's their assets that you're managing.
Okay. So
Yeah, I mean, very similar answer. I mean, like, if you pull out because like counterparty risk is a thing, then obviously you discuss first with the mandate you have, like, is it okay for you to pull out because of safety reasons? And then if it's okay, you obviously do it. But yeah, if you have KPIs, you have them in the contract, you have to fulfill them, right? On the prop side, I mean, you can do whatever you want in the end.
So for the market making side, are you holding your own private keys? So you're in charge of figuring out custody, and you can't give that away to anyone else because you have to have access to your funds all the time, right? Either on a hot wallet or in a way that you can get it on the hot wallet very quickly. So does each market maker basically do their own custody?
Well, I mean, it comes down, right? If we're talking centralized exchange market making, then normally you have a wallet at exchange that you trade out of. There are like other solutions right now where you have like this off-exchange model that you can hold the assets in a in a separate custodian and then basically replicate them on the exchange and trade like this. DeFi is then obviously a completely different story.
Yeah, I think in general we try to take an approach of keeping the minimum on the exchange as possible to do the service that we've been asked to. So we'll use third-party software where possible, or providers, Fireblocks, Copper, and the such like, to keep balances off exchange when we can. And then there are certain cases like DeFi, like Patrick just mentioned, where we will have to manage our own wallets, especially when it's not a sort of a Uniswap type situation. If it's a DEX, a particular chain's DEX, then we would have to manage our own wallets.
Yeah, it really depends again. But when our assets are on the exchange, then we don't have the control we'd like to have, right? Obviously, for obvious reasons. Just because generally it's the exchange controlling the assets. We saw that with FTX, and they could potentially do whatever they want with it. That's CeFi, right? CeFi set up the wrong way, as it's set up right now. If you look at DeFi, it's a different story again. But if you look at back to CeFi, the market is also evolving there, right? If you look, for example, at the custody providers, maybe some of those are in the room, Fireblocks, Copper, and so on and so forth. What they try to do is actually try to, well, number one, try to make some more money than they do with custody. And they try to integrate vertically, right, up or down. So they're trying to develop, in addition to the custody layer, also a clearing or settlement layer. So that, that risk that you have as a market maker when your assets are on the exchange and controlled by exchange is mitigated. Because you can keep your asset at BitGo, Copper, Fireblocks if you want, and then basically have those assets leave only when you have traded something on any of those exchanges, right? So, but the answer is, we'd rather have control on our assets, but when they're on exchanges, they're just out of our control. I'm exaggerating now, but I'm saying we don't control the private key. You can withdraw, ask for withdrawal, but
Wonderful. Well, I think that we provided tons of information, especially you three, during this panel. And I'd like to say thank you to everyone for joining us. And if you have any questions for these three market makers, please do find us after this discussion, and I'm sure that they'd be happy to help. Thank you.
Let's give a big round of applause. Thank you.